Solutions, you're absolutely in the right place for the Delivering Tax Alpha webinar today. We want to thank you for taking time out of your busy schedules to join us. It's really great to be with you, and welcome to our May Delivering Alpha webinar. This is a series of webinars that we've started to focus on specific strategies and tactics to help you deliver more client and investment alpha. We've got a terrific program, but I just wanted to clear up a couple of housekeeping items. If you've got an audio problem, if you get feedback or something like that, then I'm guessing you're listening to it on your computer. And if you'll just switch to dial in on the telephone, then there shouldn't be any problems. We're absolutely going to try to get to all the questions you have to ask today before we sign off this afternoon. So if you'll use that question box in the GoToWebinar toolbar on the right-hand side of your screen, that's what we'll be monitoring for those questions. There is a replay of this webinar that will come to your inbox in an email tomorrow, so watch for that. And there also is a short exit survey, if you don't mind, from a QA perspective. If you wouldn't mind just taking 30 seconds to complete that survey for us, we would really appreciate it. Okay, so having said all that, we really understand what keeps you awake at night. Since last fall, as an organization, we've really dug deeply into what stresses you out, and two of the biggest stressors we hear from you are worrying about what's going to happen with your client's future and where are you going to find new clients. And in both cases, taxes are a big factor. If you can minimize the tax drag on a client's investments, that's a big savings for them and something they're going to brag about to their friends, which means you get more referrals. And when it comes to talking to new clients, I know a lot of us have always talked about, it's not what you make but what you keep. And if you can add some value, what we call tax alpha, to that conversation, then you really have achieved a lot. So, Barrett, I think you're in control now. If you want to pop the slides up, we can go to the agenda. And today's agenda is going to be pretty fast-paced. We're going to spend just a second talking about who Adhesion is, because I know there are a number of new folks on the line. We're going to talk about what this concept of tax alpha means, why it is important to you, and what you can do to deliver it. So who is Adhesion? And so Adhesion, at our heart, we're a TAMP. We really think that you can have it all. And we're not just a plain TAMP, but a hybrid TAMP. And with us, you get the leverage of a structured turnkey solution and the customization and flexibility of an open architecture UMA. You really define the investment value proposition, and we can deliver it for you. We are a solution for a slice of your AUM, or we can be a complete outsourcing solution. The second thing we are is we're about human capital and technology. Next slide, Barrett. We're based on an extremely sophisticated UMA platform. It really is third generation UMA platform. And so we're not limited to just mutual funds. We can, of course, work with those funds, but we also can work with ETFs and SMAs, all as part of your investment solution. By outsourcing to us, you get more than just a black box technology, though. You get a team of overlay portfolio managers. You get human capital. These are people that really have your back when it comes to watching all the trading and implementation and reconciliation, and at the end of the day, delivering your alpha. Next slide, Barrett. You can take advantage of what we call our model exchange, Adhesion model exchange, in a couple of ways. We offer a terrific portfolio of proprietary strategists who are going to drive asset allocation for you, who are going to help in the selection of ETFs and all of that. Or you can choose to use our fully leveraged specialists. And these are folks that will do everything from soup to nuts when it comes to driving your portfolio with multi-product allocation strategies, multiple sleeves of different investment strategies. Next slide. But at the end of the day, I think what a lot of advisors tell us that they really appreciate about us is that we're 100% for you. We were built exclusively for the investment advisor. We have not been modified from some other technology or some other channel. We have been built from scratch. We don't have a lot of bolt-ons. Our DNA is pure RIA. And you'll hear more from your peers when we get to the end of this presentation about the 100% solution. And really, we fit for a lot of different types of businesses. If you're an investment advisor or a wealth manager, or if you're an advisor in transition, I think you need to talk to Ty McDaniel, one of our managing directors, about how we can solve some of your investment solutions. So Barrett Ayers is our Chief Solutions Officer. Barrett, tell us a little bit about how advisors can create more value with their clients by being tax aware.
Terrific, yeah, and thanks, Jack. Thanks for the introduction. That was terrific. And also, before we get into that, I just wanted to thank everybody for joining us today. I really appreciate this. We are gonna. I think this is going to be a really fast-paced topic. Hopefully, it's something that's timely and interesting to everybody. I also hope that kind of enough time has elapsed since kind of tax season that the fog of war has lifted from your day-to-day operations, and you can look at this through kind of a clear lens, and hopefully it's an interesting topic for you. So yeah, so anyway, Jack, the plan today is that we're going to spend a little bit of time this afternoon discussing the importance of active tax management and ways to generate additional portfolio value to your portfolios, to your taxable clients, your taxable portfolios. And kind of first things first, what I was hoping to do is spend a few minutes kind of simplifying a kind of a complex term that I think is a bit overused and maybe even a bit vague in our industry, and that's this concept of tax alpha. You know, adhesion is one perspective. We believe personally that any time an advisor is actively managing a client portfolio and achieves additional incremental value for that portfolio, usually through minimizing the client's tax liability and retaining part of that portfolio value, you're effectively producing what we consider to be tax alpha. And so doing it, understanding it, that's kind of the easy part, right? Actually managing the tax management, that's relatively straightforward. The difficulty is in measuring and quantifying the value, and that's really where the debate starts. That's where kind of it gets very complicated, and it's difficult to articulate, difficult for a client to understand. So we've kind of scanned the industry, and there's kind of a whole host of different ways that people kind of articulate this thing called tax alpha. So some folks we hear from attempt to kind of generate a relative return, and that is kind of comparing a portfolio to a benchmark both before and after taxes. And I'd say it's a complicated approach that really relies on a whole host of assumptions, and probably the most notable of which is you've got to compare this theoretical after-tax portfolio to this actual pre-tax time-weighted return, all compared to this theoretical benchmark. And it's a theoretical benchmark largely because, well, benchmarks, they don't pay taxes, yet in order to kind of level the playing field between the benchmark and the portfolio, they have to be adjusted as if they do. So at the end of the day, it's a real difficult concept to explain to clients, and it usually comes across as a little bit confusing and at best manufactured. On the other end of the spectrum, we have those who simply apply the client's marginal tax rate to their actual pre-tax time-weighted returns. So the client portfolio was up X%, the tax bracket was X%, multiply the two and get this kind of adjusted time-weighted return. Obviously, this is much more of a what I call kind of a sledgehammer theorization, in that it doesn't really consider any taxable transaction. It's not real, and it doesn't show any incremental value that you added to the management of the account. So we believe in a couple of fundamental requirements of tax alpha. We believe that it needs to kind of guide the way the number is constructed and the way that the advisor interacts with the client. So the first thing is we think that tax alpha, in all cases, should use real, tangible, actual transactions. It should be a real reflection of the client portfolio. It should have actually happened in the client's portfolio with actual transactions. It should use actual tax brackets. And lastly, it should be easy to explain. It should be easy to understand. You should be able to reconcile it back to what actually happened to the client portfolio. So we believe in kind of transparency and demonstrating what actually happened. So we're going to discuss that offering, how we visualize this information here in just a moment. But the better question is, why is all this important? Why is delivering tax alpha even significant? Why is it creating so much buzz lately? And first off, as most of you know, the stakes have been raised. Last year we saw Congress pass this American Taxpayer Relief Act, which increases both the short and the long-term capital gains rates to 39.6% and 20% respectively for the nation's highest income earners, and that's AKA your target market. So it also introduces a new Medicare health care surtax of 3.8% for those same TOPS earners that affects both dividends and capital gains. So the bottom line is that the overall tax environment is challenging, and it's becoming even more challenging for that core demographic. Secondly, the instruments that most folks use to develop portfolios and construct asset allocation, the instrument of choice in the advisory community is the mutual fund. And it's both tremendously taxably inefficient, and to make matters worse, it's also very expensive. So this is kind of an interesting statistic I put up here, and it's according to Morningstar, and it looks back over the past 5 years, and it looks at average active equity mutual funds, which, as you know, the mutual fund instrument passes along all of its embedded tax liability to the consumer regardless of their individual holding period in that mutual fund. Well, it's penalized investors by 1.26% annually due to taxes. So that's erosion of the return simply because of the investment vehicle that they're holding. And because individual investors don't hold their own holdings, there's no way to institute some sort of tax management on top of those mutual funds. So again, that's simple performance erosion due to just the inefficiency of the vehicle themselves. And that's a big number. The second thing is they're also expensive. And I think most folks kind of instinctively know this, particularly when you compare them to separate accounts, where the individual investor holds and owns the individual underlying tax lots and the resulting tax implications. Mutual funds, again, are very expensive. The average equity fund expense ratio last year was about 92 basis points compared to about 52 basis points for a model-based SMA at around 50 or 52 basis points. So in the past, really the excuse for using mutual funds over separate accounts was cost, it was convenience, it was access, and really, as we'll discuss in just a moment, none of those are no longer really valid points. So we think it's hard enough to achieve active returns when you have these heavy and, in most cases, hidden headwinds working against you. So one of the last things we're going to talk about then is one of the things that is mostly out of our control, and that's really the fact that tax management has never really been easy, but it's increasingly challenging when all those tax lots that are left in the portfolio have already been kind of picked through. It's bad enough that you've got this highly punitive new tax code as the backdrop. You've also got an increasingly challenging bull market to unfortunately operate against. So we see this, it's funny because over the last few months, the last couple of quarters, we're starting to see it trickle into the tone of the advisor and client communications. We think it's going to become an increasingly complicated and expensive proposition to get your existing clients to move into new strategies. And as they adjust their risk allocation, moving into those new strategies and adjusting them will become expensive because of the tax cost. But worse yet, as you're working with new prospective clients and expanding your book of business, the tax cost that those new clients will have to undergo to basically transition over to you becomes so prohibitive to the point that maybe it just makes sense for those clients to stay put, even if the advice where they're at today stinks. So you need to have a message and tools that counteract and in some ways counterbalance that sort of client inertia. So we're going to talk about that here in just a moment. So clearly it is a challenging environment and backdrop to operate against, but there are ways to tilt those conversations in your direction and kind of highlight the value that you bring to the table. The first thing we do is we strongly recommend the use of separate accounts for those clients who have a strong aversion to taxes. Mutual funds, as we've mentioned, and just about everybody knows, are tremendously tax inefficient, as we discussed, can be quite costly. Separate accounts, on the other hand, can be customized, right? So they can have customization, they can do tax management on top of them, and are generally available on model-based platforms at relatively low minimums. And we hear a lot of folks talk about the trading costs. We really suggest don't consider that as a hurdle. Most custodians can offer asset-based pricing that, even when wrapped into the cost of the account, are generally cheaper than funds. Second, and this again is if you choose to do this on your own, consider that managers and products that you use try to avoid dividend and income-producing products for clients who don't require current income. It certainly makes sense to tilt the portfolio away from income-producing products if there's no current income as the investment objective, particularly since those dividends and income are treated as ordinary income. So the last thing is you may want to consider looking at low turnover SMA managers or those that have an eye towards tax management. And that term, tax aware, is really overused in our industry. A separate account manager that is truly tax aware generally keeps an eye on the holding period for a given security, attempting to hold it until it achieves a long-term gain status. But they try to wash sales, and sometimes they'll do on-demand harvesting services. But generally speaking, their loyalty, and it probably should be, is towards the purity of the investment strategy itself. And the other thing I'll mention real fast is if you're going at it alone and you choose to use separate accounts, just a word of caution that some managers that claim to be low turnover don't necessarily mean that they're tax aware. And sometimes those terms think they can be interchangeable. They're not. So even though you're tax aware, you can do a lot of tax damage to a portfolio with very low turnover. And the other thing too is anytime you combine separate accounts without the use of a coordinated model-based unified managed account platform, you do run the risk that one manager is actually undoing what another manager just did, resulting in a wash sale and the possible over or under concentration of a given holding or sector. And we'll talk about that in a little more detail here in just a minute. So if you don't want to go it alone, it feels like it's a overwhelming task to do it on your own, and we think it is. We do suggest considering using a unified managed account platform like Adhesions to not only run the strategy but also to implement a tax overlay strategy on top of it. I do think, though, first to put it into a little bit of context, I did want to take a real quick step backwards and kind of go over what a unified managed account is for those who don't understand it. And I think more importantly, underscore why it's, I would say, arguably the only structure that can truly deliver true tax management. So if you look at the visual here on the screen real fast, the first thing you'll notice is that the separate managers on the top, they provide their models and their trade signals and their indications to Adhesion, who operate in the capacity of what we call an overlay manager. And that overlay manager is responsible for overseeing and coordinating all the trade activities of the manager and the advisor. So in this example, let's, for the sake of this discussion, the advisor blends those separate account managers, as you can see in the top box up there, along with ETFs, mutual funds, and other proprietary models that they may develop on their own. They blend them together as they see fit into a fully allocated strategy. That strategy, if they want to, can be used for one client or multiple clients with the same investment objective, which on the side note, is an extremely scalable business model for those of you who are looking for a kind of a catalyst to ignite growth. The strategy, once built for one client, can usually be deployed and developed for multiple clients, highly scalable. The advisor then collects and defines the tax rules for the client. So that's the set of rules down in the lower box. And again, the overlay manager coordinates and is responsible for making sure the manager models and the manager rules kind of live harmoniously together with all together. So as an example, consider this. A unified managed account platform can, on one hand, take in the model signals from the separate account managers, but at the same time follow a series of client rules. So let's say avoid sin stocks, never trade small amounts, keep non-manager cash, that is client cash, partitioned and segmented at 5%, all while ensuring the account is actively tax managed to this particular tax mandate. Clearly, it takes a lot of horsepower, technical horsepower, and human capital, human experience to execute this sort of coordination. So with that as a backdrop, I wanted to explore a little bit of the tax rules that can be applied as part of a tax overlay strategy. So the first thing, obviously there are many effective techniques to minimize taxes. We think one of the most effective of those is harvesting losses in portfolios that are obviously taxable. In theory, tax loss harvesting is pretty straightforward, right? You simply identify those tax lots where the current market value of the tax lot is less than the initial purchase price of the tax lot and sell them. And then you offset your current year gains with the accumulated losses. So again, in practice, it sounds, in theory, it sounds really simple. In practice, obviously, there are many, many more challenges, as I'm sure all of you understand and appreciate. For an advisor with, let's say, hundreds of clients, each with, call it 2 taxable accounts, you may have dozens to hundreds of holdings per account per year. Each position may have a dozen tax lots. The average client may have a 3 to 5 year tenure. So on average, you can assume that a typical advisor with taxable accounts has north of 150,000 tax lots that they have to wade through to harvest and kind of pick and choose from the individual losing lots. So with this sort of kind of big data challenge, it obviously stands to reason that many advisors don't employ the technical or human wherewithal to do this on a regular basis, and most advisors we talk to tend to do it once a year, usually in mid to late December, because again, it's such a manual and labor-intensive process. And it works, right? It works to a certain extent. It's very brute force. It's one way of managing taxes that's not really taking advantage of your core competency of managing a relationship and developing your client investment plan. And secondly, it's really nowhere near an optimal solution. That is, selling it once a year in December is not an optimal solution. And here's why. The markets, we all know, tend to fluctuate. They don't live in a consistently trending pattern where mid to late December is the low point of the year. In fact, we went back and we looked at the S&P for the past 30 years, and we saw that in only 2 years in that 30-year window did December represent the all-time low for the year. In fact, that was 2001 and 2008. In fact, over those same 30 years, December was actually the all-time high in 11 years. So, and in every single one of those 30 years, as you can imagine, there were dozens of little mini corrections throughout the course of the year that would have served as a really good opportune time to generate and capitalize on some of those losses. So the point is that tax harvesting is not bad. It's just that there's varying degrees of good. The other point is that advisors should really think about taking advantage of losses throughout the year, but it's stressful to do it on an ongoing basis. So an automated tax overlay strategy can capture client tax management rules and apply them on an ongoing basis to take advantage of those mean reverting trends we see in the market. So second is consider extending the holding period for significant gains. And we think that's really important. So the short-term gain bracket is becoming even more punitive at nearly 44% for your most wealthy clients. It's exceedingly important that we protect against those types of transactions whenever possible. We often set up what we call kind of an intelligent gain deferral rule where we defer significant short-term gains that they're about to go long. And we look at that relative to not only the initial purchase price, but also the size of the gain. So in some cases, clearly we don't want to defer a $100,000 trade if it's only protecting a small $5 short-term gain. So we look at it both in relative and absolute magnitudes. And the third thing is avoid really high penalty trades, such as a wash sale. You know, generally speaking, a wash sale occurs when you sell a position for a loss, but then purchase it back the same or substantially identical security within 30 days of that sale. The result of the wash sale is that the loss must be disallowed, meaning the loss must be added. The amount of the loss must be added to the cost basis of the repurchased asset. And it sounds really straightforward. It sounds really easy to avoid. But for those of you who are using separate account managers, particularly those who have multiple separate account managers in a relationship, you probably run into this all the time. You know, you've got one manager, say an all-cap core manager, buying and selling, and even though they may claim to be tax aware, they're not coordinating with the manager next to them, the large cap value guy. So one manager selling Google at a loss, meanwhile the value guy's buying it up. It happens all the time. Folks who are experiencing it all the time, I'm sure you're nodding your head. The way to avoid this, again, is to consider use of a unified managed account platform where there's an overlay manager coordinating, being a traffic cop and coordinating those manager trades. Really, really important. And the last one, and you know, this is probably an obvious one, is defer it. Defer it entirely. Don't take it. Don't sell something at a short-term gain. Don't sell something that doesn't make sense if you don't have to. One option folks use in our platform is what we call a carve-out. That's where you can protect individual low-basis kind of legacy holdings. And our platform employs something called a carve-out feature that permits advisors to designate individual specific tax lots to be protected. So after doing this, advisors can then avoid over-concentration by adding do not buy rules and sector concentration rules. So I'm carving out all these shares. I don't want to buy more of them, and I probably don't want to buy more of that sector because maybe it's already doing so would kind of create an overweighting. From there, ongoing harvesting of other losses elsewhere in the portfolio can be built up, and then we can develop a workout plan with the advisor to conditionally dispose of those low basis positions using these built up harvesting losses. The second thing that's really neat, and it works well inside of a unified managed account platform, is what we call swapping, where you swap advantageous lots rather than selling. So you do that by looking at individual tax lots within contiguous managers. So the way this works is if you have two equity models, you know, in the same account, one manager goes to sell a holding, the platform should look at other managers that are holding that security to determine the best course of action. So if the manager selling the lot has a low basis, but a higher basis exists elsewhere in the portfolio, the target lot should be swapped out. So in doing so, as you'll see in the graphic up there, the higher basis lot is then exchanged with a lower basis and then sold, in some cases eliminating, if not minimizing, the tax impact. The other approach is, again, looking elsewhere in the portfolio, is to look for underweighted holdings elsewhere in the portfolio. The shares here can be eliminated, but instead they actually get exchanged for cash in the underweighted model. So effectively what's happening is you eliminate two trades. You're swapping cash for stock across models inside of a single account. So what happens there, you eliminate in sleeve A and you purchase in sleeve B, you avoid the transaction costs, and you also avoid the taxes on the sales. again, a really good way to avoid minimizing taxes through some really sophisticated technical capabilities available on a unified managed account platform. So again, using a specialist's very effective techniques can be used to offset taxes. There are some prerequisites, though. So if you're considering a unified managed account platform, there's a couple of questions to ask. We think that one of the most important questions is how do you handle tax lots? It has to be done right. It's not something that typically comes up during some of the cursory reviews of platforms, but it is really important, and it has some deep and impactful effects on the portfolio. The way you account for it, the way you reconcile for it, the way you communicate it up and down to up and downstream providers, it's really, really important. So you can imagine that if tax lots are not in sync across providers, it can get really, really messy. And the stakes have been raised, right? So the custodians, as most of you know, are now the gold standard for the tax lots. They own the cost basis with the introduction of the recent cost basis regulations. So in my opinion, the questions to ask are, first, does the platform and does the custodian permit a dynamic method of communicating the write-down of the tax lot? Most custodians do. They support something as like a tax-optimized or beneficial relief method. Most custodians have some sort of dynamic relief method that can be utilized to anticipate the best lot to sell. But while these relief methods are terrific and they work most of the time, there are occasionally exceptions, such as wash sale prevention rules or gain harvesting, where the overlay manager may be sending something, but it's not what the custodian expects, and the best lot is not evident, and it's not what the custodians expected. So to facilitate this, the platform should support a versus purchase write-down method, and that's really where the overlay platform designates the very specific tax lot to be sold regardless of the custodian's de facto kind of standing relief method. And then finally, and this is really, really important, and we've seen too many of our current clients be burned by this in the past, make sure to check that all the systems that are involved in your ecosystem are in sync. The custodian, the client reporting system, the advisor analytics, and the investment platform, all of them need to agree on the lot structure. And if they don't, then you're not agreeing on what lots are being sold, what lots are remaining, and you're also not agreeing on what the realized gain loss is for that particular account. If not, you have one platform, say your performance and reporting platform, communicating one realized gain loss information to your client. The custodian is indicating something entirely different. And finally, your rebalancing system, the system that's making the investment decision based on an entirely different lot structure. That's why it has to be in sync, and we think that's really important. That's why we built the Adhesion platform as a tightly coupled platform. It includes all that information all synced up. So in addition to using a specialist, we think that's really important, getting the tax management rules right and tight, actively applied in a rule-based format. We also think it's important to not only apply that, but then look backwards and then communicate your value. We think it's really important to do so in simple, easy-to-understand terms that your client can appreciate. We think it's really important to do a few things here. And we put these into a couple different categories. I look at them kind of for existing clients, and then I look at it kind of for new prospective clients. So for existing clients, let's talk about them first. Showing them a roadmap of what you've delivered through tax management is key. Try to communicate tax alpha, but we think avoiding arcane or vague formulas like we talked about earlier. Again, they sometimes come across as manufactured or engineered. And the worst is if they look like they're intentionally opaque, then you've got kind of a communication and trust problem that we're really trying to avoid. Again, try to use actual information, actual tax brackets, and live transactions. And second, use simple, clear, and concise visuals to demonstrate concepts. So one of the things that we've recently released is what we call the Tax Alpha package, and it does, as you can imagine, all the above. So we use actual harvesting transactions, actual tax management transactions, actual tax brackets, actual transactions. It's all legitimate, live, real. And here I've just pulled up a report. It's called our tax burden reduction report. It shows the clients what we call liability reduction. We actually go through, we show the tax liability using, again, the client's tax bracket given actual transactions on the account. We then counteract that with the harvesting activities that happened to date and derive what the client would have paid without harvesting activity, then compare that before and after. So the savings is what we call is called liability improvement. So effectively, here's what you would have paid the IRS before, here's what you would have paid the IRS after, and here's the delta. And that delta we compare to the market value of the portfolio, and we call that tax alpha. We also think it's really important to put it into a historical context. So in this report, as you can see, we plot alpha over multiple periods. In this one, we've got current year, last year, and a rolling 2-year basis. And it's important because not all years are what I call, as we all know, the most conducive to a tax management program. So we do need to encourage a longer-term perspective. And, you know, it's worth it. It really is. Holistically and historically, we've seen that an active tax management program can add upwards of 60 basis points of this tax alpha a year to a client account. And it's a lot of work. It's something that the clients can understand and appreciate. So it's really important to demonstrate the value through reports like this and active conversations like this. So then let's move into prospective clients. Let's talk a little about value and demonstrable value add to those prospects as well. Consider offering transition assistance. As we've mentioned before, for kind of this 5-year bull market, it's making it very, very challenging and expensive to get assets off the sidelines. We think clients are becoming even more reticent to move assets when faced with this massive tax bill. So first, it's important to demonstrate what the expected impact will be for them to move to your target strategy. So what I'm showing here is what we call our holdings transition report. It basically compares existing client tax lots, and again, this is for a prospect. These are assets that are held away. These are assets that are not held with you today, versus a target strategy that you have designed and proposed to your client. And it's basically showing the transition. It's showing what's overlapping, what's underweighting, and what's eliminated. It's a roadmap, effectively, to implementation that kind of sets the relationship out on this positive, honest footing. But while honest, it can also be this stark, unexpected reality to the client, particularly considering, again, most of the tax losses have probably been picked through from their former advisor. But there is a way, right? There is a way to counteract the stress your client may feel after seeing this, tremendously tax-impactful transition report, if you can lay out a step-by-step, clear, easy-to-understand transition plan. So I want to talk about that for just a moment. The transition plan that we talk about for prospective clients is really designed to, let's say, lay out a series of real predictable steps that shows specifically how you're planning on moving assets over and the ways you plan on shielding that client from an otherwise large tax bill. So how's this work? After laying out the tax impact report we just talked about, right? So we've already showed them what's being sold, what's being held, what's overlapping, and basically here's the bottom line. Next, working with Adhesion, you can consider developing a transition plan that stages in the client's assets to your strategy over the course of a 1 or 2 year, kind of a multi-year window. To do this, Adhesion would help you bifurcate the client portfolio, retain some of the client's low basis legacy holdings that are then modeled around a replicated predictable index, such as an S&P 500, a Russell 3, or Russell 1. Then, in working with the client, to develop a series of transition rules, things like gain budgeting, transition periods, tracking year ranges, and portfolio staging levels. Some of those assets will then be liquidated to effectively fund your target strategy, right? So we've now bifurcated the portfolio. We've got some that are absorbed into this custom core strategy that's following, let's say, the S&P 500, this modeled, agreed-upon index, and the rest is then liquidated and moved into the target strategy. So on day one, the managed portfolio can be adapted. So the managed side, your target strategy can be adapted and modeled and risk-adjusted to accommodate this new S&P 500 core index. Because, again, it reflects a predictable beta component in the overarching strategy. So it's easy to model, it's easy to predict, it's easy to model around, let's say. But over time, and this is what's important, that core index model is whittled down, right? So we're opportunistically harvesting losses within it. So even though they're low basis positions, we'll look at the tax lots and we'll start to harvest within it, or we'll build up losses in the target strategy, in the managed part of the portfolio. So we'll harvest in the managed part of the portfolio to build up losses there and counteract gains in the core and move them over opportunistically. And we'll do that over a period of time, and as that custom module is eventually whittled down, the strategy can again be risk adjusted back to the intended allocation. And this is just repeated periodically, and it's done again and again until the index is eliminated entirely. This is obviously what I would call a high finesse method of reducing taxes and getting assets off the sideline with what I would say is the least amount of friction. It's not meant for every client, clearly, but it is definitely nice to know that those tools exist as you encounter this type of client, this high net worth, low basis, usually demanding client, and attempt to differentiate yourself and eventually unfreeze those assets. It's a very, very effective technique. So I'm going to wrap it up. I'm going to bottom line it here. First and foremost, the environment, as we all know, is getting tougher. It's getting much tougher. Stakes are being raised through these higher tax brackets, the higher tax costs, and it's affecting your most important client segment at a point where there are probably very few losses left in the portfolio, and the backdrop is more challenging than ever. Next, you should consider minimizing the use of these inefficient vehicles like mutual funds wherever possible. We understand it doesn't make any sense to completely eliminate mutual funds from your lexicon. It makes more sense to consider slowly adopting separate accounts as possible because mutual funds are expensive, they're very tax inefficient, so the extent you can move to separate accounts, we think that makes a lot of sense. Consider using an investment platform like Adhesion to apply that tax overlay strategy we talked about, and it's historically added upwards of 60 basis points to client portfolios, and it works. It works. There's historical evidence. We know it works. And there's something to talk about with your client in terms of value and communication. And on that point, finally, communicate the value you add to both your existing clients through the use of tax alpha reports and transition services to your prospective clients. These transition services we think, are the best way to get frozen, low basis positions off the sidelines, to get those high net worth clients moving, and start to pick up assets and grow your business. So with that, I really want to thank everybody for sitting in on this session. I'm going to hand it back to Jack and let him wrap it up and get everybody here out on time.
Thanks, Barrett. Awesome job. Hey, folks, if you've got any questions, feel free to type those into the question box. What you've just heard Barrett talk about is how we use our technology and human capital to serve up the model exchange. What Barrett hasn't touched on, the value that we get from those outstanding managers and strategists that you can access through us. So let me ask you a couple questions. Are you managing investments for your clients today? Are you using TAMPs or SMAs? Because if you are, we can absolutely add tax alpha through all of the processes that Barrett has laid out for you today, as well as investment and client alpha in many ways that you didn't even see today. Whether you're looking for a home for a slice of the assets that you have under management or you're looking for a complete outsourced solution, Ty, our managing director and head of sales, wants to have a conversation with you. You're certainly welcome to go to our website to get more details, and we have some specific case studies from clients who are using these strategies and these technologies, and they're extremely enlightening. So take a look at those. Watch your inbox. There will be an email coming to you tomorrow that will have a replay from this. I know Barrett went through a lot of information in a very short period of time, and a lot of you probably couldn't write as fast as he was talking or the slides were coming through, and you're going to want to drill down into how this works. That's exactly what Ty is expecting you to do. So give him a call tomorrow at 980-321-5842, or you can email him at tymcdaniel@adhesionwealth.com. So with that said, thank you all very much for joining us. We look forward to seeing you next month for our next Delivering Your Investment Alpha webinar. Thank you all very much, and have a great day.